Okay, we're going to get started today by looking at the S&P 500 like we usually do. You can see a very positive thing that's happened recently is we've been hugging the 20-day exponential moving average. And you can see that where the S&P briefly went down to hit the 50-day moving average, and now it's back at the support of the 20-day exponential moving average. We had some volatility in the stock market recently, and I'll talk a little bit about that. Um, it seems like whenever the stock market is pricey, like we've been saying, um, any little story that can be taken as a watershed moment, and the stock market sells off. Trump had a comment on Friday, this past Friday, that he was going to have 100% tariffs on China. And as soon as I heard that, I thought, oh man, he's bluffing again. But the stock market did sell off a lot. And it seems like those tariff announcements are negotiating ploys. We'll talk about that later on. But in the meantime, you can see that we're still on an uptrend in the S&P, and you can see that we're still within the channel that we started way back in April. So as long as we're being supported by this moving average, seems like it'll continue to go up. We're oversold right now. You can see that the stochastics are, no, it's halfway between overbought and oversold. Um, so I think right now, yeah, we're at 50 in the S&P. So that's halfway between overbought and oversold. We're in a kind of no man's land right now. But we do have earnings coming up. Let's look at our talking points. We do have earnings coming up. You can see we started earnings this week with the banks, with Citi, JP Morgan, Bank of America. I think the earnings came out better than expected, and a lot of the bank stocks jumped um, in financial stocks. We had American Express report, and they had a better than expected earnings report and guidance. So that stock went up 7%. So that's pretty good. We'll talk about American Express later on. Now we got some more earnings coming out, the big tech stocks, and a lot of times that's a catalyst for the stock market to move one way or the other. Let's look at the earnings reported this week. You can see TSMC reported. It seems like they reported better than expected earnings, but the stock went down for some reason. Um, we had all the banks, a lot of the banks report, and for the most part, better than expected. American Express reported on Friday, and that was better than expected. So next week we have to look forward to a lot of the big tech stocks. We have Netflix coming out on Tuesday, Tesla, and then IBM. We have Intel coming out on Thursday, and then Procter and Gamble is on Friday. So we're right at the beginning of earnings reporting season, which is super exciting for me. Um, okay, so let's look at our numbers for this week. We're kind of losing momentum in the stock market recently. It seems like the we have some fear in the market, so people are not trading up stocks like they used to. So we're getting a loss. We're having a loss of our translation. If you have between 30 and 70% of the stocks above the 200-day moving average, then we're neutral. So there's no real momentum right now in the stock market. It's kind of fear, and we're still in October. There were some famous crashes in October, so a lot of times people are on the edge and ready to sell in October. But historically, October is a good month to invest. It's usually up 1% on average. But you can see the VIX is normally high during this month. That means it's very volatile. Stocks go up and down lots during this month. So be ready for volatility. But we always have no, we do. We usually have a end of the year rally in November and December, um, primarily because we have three major holidays crammed into each other. We have Thanksgiving, New Year's, and Christmas. So a lot of times that makes the stock prices go up. Okay, let's look at, we already talked about this. Let's look at the 10-year. This is really interesting to me. This is a sign. Look at this. It's going down. And um, usually the stock market goes up when the yields go down, but this time the stocks went down when the yields went down. So that's usually an indication that the economy is kind of slowing. Um, let's look at some more of the numbers. We have oil down 50 to $57 a barrel. There's a lot of reasons for this. One of the reasons is the global economy is slowing or more supply in the market. That's one of the two things. And I just did a double take on this. It went down a lot. Um, so that there's fear that there's a slowing in the job market and in the economy. So we're going to get some more economic reports coming out, which could help out understand that. Inflation is a little bit higher than it was last week. It's 2.92. The US dollar isn't going down this week. It's just unchanged. And gold is on a tear. It is up 8% this week. That is pretty amazing. Um, so it looks like there's a lot of central banks buying gold, and there's a momentum trade. So, and we had some fear in the market this week where Trump said there was 100% tariffs and the stock market went down, gold went up. So we're going to keep our eye on gold. You see, gold is known to hold its value over time. So back in 2000 years ago, gold was used as a means of holding value, it's always worth something. Um, and even now, whenever there's crazy times and people are afraid, people lean into gold. Now let's look at the US dollar index. It's interesting. We were in a downtrend for quite a while. We kind of broke out of that at the beginning of October. So that's interesting. So we'll keep our eye on this, but that is an indication that we might be going up in the dollar. We'll see. I'm not sure. The fear and greed index. We have fear gripping the market right now. So I guess it all started this past Friday with the tweet from the president um, saying that there's going to be 100% tariffs on China. And couple on Saturday, he said, "Oh, things will be fine." It's kind of a whiplash kind of stock market. Let's look at the AAII, American Association of Individual Investor Survey. We have bearishness in the market. So our translation is when the amateur investor is bearish, that's time to look for something to buy and don't sell. Okay, so the VIX, you can see that it's going up substantially this week. It's up to 20 now. You can see the volatility is picking up. That's right on time. We were saying, let's go back and look at our VIX. It's elevated as in September and October. It peaks in October, and then starts going back down. In December, it's the lowest. It's the lowest in January, December. No, July. It's the lowest in July, and it's lowest in end of end of the year and beginning of the next year. Okay, let's look at, okay, this just a friendly reminder where we are on the valuation emotional chart. Where you have fear right now in the market. You have to make sure you understand where you are. You can't get yourself suckered into um, the common reactions whenever things are going down to sell. You have to keep in mind, keep your emotions in check and don't let yourself get into a despair. Everything is going down. I'm going to lose everything mindset. And you want to have a genuine, um, enthusiastic, and level-headed approach when you're investing. And we mentioned things that could lead to a crash. Okay, well, tariff threats. That exact thing happened on Friday when Trump said 100% tariffs on China. So right now, if that happens again, you have to understand it's just a negotiating ploy and not to take it too seriously. Okay, let's look at the PE ratio right now is 25 to the stock market. That is really high. It's one of the highest in in our history. So we could trade off a little bit and still be within the realm of fair value. Okay, let's look at our first to worst. The best performing sectors now, communication services and IT, both up 23, 22%. Utilities is one in a good sector also. And the next best one is industrials. Okay, so um, we have a lot of laws being passed that you can build um, that give tax advantages to buildings for industrial purposes, and that could be helping the industrials. Real estate's up 0%. Healthcare and energy are really low percentage, and consumer discretionary 0%. Wow. So what you're seeing in all this is we have a strapped consumer that's spending and running out of money. And you can see that consumer discretionary is 0%. That people aren't buying things that are luxuries. They're keeping with the essentials right now. And interest rates, um, they're still relatively high. And whenever they go down some more, then real estate might do better. Healthcare is only up 4% and energy up 0%. All right, let's look at the sectors evaluations. So you can see energies, financials, healthcare are all kind of value plays right now. They are trading at the lowest valuation of any sector in the stock market. IT is trading at a historical, very high PE ratio. So is consumer discretionaries and industrials. So whenever you have market volatility, it's just kind of whenever you have a volatile environment, these stocks usually go down. The ones that have been flying high, that have a high percentile versus history. The ones that do the best are the ones that are more defensive, like these ones. So that's what we had on Friday when Trump announced the 100% tariff on China. Okay, so let's look at some of the sectors going up and down. We can see Kenvue. Hey, we talked about that recently. We mentioned that it's a consumer staple. It has some of the best top, it has some of their products are some of the top 10 products sold. So we were mentioning that Trump administration said, well, the CDC said that Trump said there was causing autism. And he said Tylenol is causing autism, and that tanked that stock. But this is an example of um, a Trump threat and something Trump says, and you can't take it too seriously. Um, there's a lot of science that says acetaminophen is not going to cause autism. And there were some Swedish studies even said they studied millions of people after they had a baby, and there was no connection. So we're going to keep our eye on Kenvue because they're a quality drug producer, and they really tanked. And sometimes whenever a quality stock tanks on bogus news, you have to buy a little bit at a time, and it pays a 5% dividend, which is pretty good. Okay, American Express, we talked about it. They had great earnings on Friday. We'll go over American Express in detail later on. Gilead Sciences, what is the theme here? We have banks, Capital One, Truist, Fiserv. Okay, we have a lot of banks and drug stocks. Look at the ones doing the worst. Newmont Mining, gold manufacturer, Oracle, Vistra. Okay, we have an AI combination there. Vistra makes power. They're involved with the AI infrastructure. Oracle, they're an AI infrastructure play. They actually provide the services. Supermicro, they help build out the AI data centers. So we have a big AI data center correction. And Corning, they're pretty big in the data center also. They make fiber cables for connecting to computers. Constellation Energy. Okay, so we have Constellation does their utility that specializes in helping some of the AI infrastructure plays. So a lot of these that are going down are AI infrastructure. So let's look at the sectors going up and down. The ones going down the most are gold and telecom. Okay, so when we look at our 10-year, we can see that we're going down in interest rates. So if we look at our cheat sheet, yields of the 10-year going down, that's negative for large cap stocks, financials, brokerage firms, and insurers. It's positive for small caps, high yielding, home builders, and REITs. Let's see if that happened today. Okay, the ones doing the best, banking, that's because of the earnings. Banks reported this week, so they have a tailwind from that. Um, consumer staples, they pay a dividend. So as the interest rates go down, that makes sense. People reach for yield, and a lot of the high yielding sectors should be going up with the interest rate of the 10-year going down. Consumer discretionary, energy, financial, select spider, oil services, home construction ETF. As interest rates go down, home um, it makes it more affordable to buy a house. But healthcare sector pays a dividend, and it's a safe haven. Energy, okay, energy stocks usually pay a dividend. All right, so it worked out pretty good for that. Okay, so it's like a one-to-one correlation. So that actually worked this time. The ones that did the worst are tech stocks, and the ones that did the best are the home builders, the high yielding stocks. So that worked out pretty good. All right, let's look at our picks from Dan Niles from the beginning of the year. His best pick is Cisco, and then the big bank ETF, KBWV, and then the worst one is IJJ, the mid cap ETF. Okay, keep an eye on that one. Okay, here's the story that came out. Trump he threatened 100% tariffs, and then on that's Friday, the market sold off in a major way, and then he came back and he said it's not sustainable, and that means he softened his tone as soon as he said, those it's going to work out fine with China. The stock market went up. So we have a lot of rare earth stocks I talked about last week. They're going up and down. And just think if there's a deal with the China to get some rare earths, those stocks will tank in a major way because we don't need to pay premium for that anymore. But right now we do have China restricting the rare earth minerals. So that's hurting a lot of the stocks counting on that. Here's another story to keep in mind. This is the closest we've had to a black swan in a long time. A black swan is something that comes out of the blue that could make the market crash. We had Jamie Dimon came out with earnings for JP Morgan this week, and he basically had some losses associated with Tricolor. Um, these are companies that basically were private companies that borrowed money big time, and they collapsed. So because of that, we had like this fear that maybe this is the next financial crisis. Um, and it turned out that it wasn't, it's pretty contained. Um, Jamie Dimon said that there could be more cockroaches. So so as an investor, you have to like keep in the back of your mind all these potential things that could make the stock market go up and down. And you have to understand if it is affecting the stock that you're watching and following. So for a lot of the tech stocks that we're following, they don't need to borrow money. So if there are collapses in the banking industry, it doesn't affect them that much. And you have to do that exercise with every stock in your portfolio because um, sometimes news does affect your positions and you might have to do something about it. But Jamie Dimon is has been like this worrywart for a long time. So I wouldn't really put a whole lot of faith in his concerns. So like during the COVID, he said there's a hurricane coming around, and then he had so many warnings that didn't come out. You have to like kind of ignore that one. Um, okay, so here's I did a screen. We got the same names as before, and I didn't see anything truly interesting. I still can't believe that Micron is selling at 0.17 peg ratio. That's like 7 times undervalued. So if there is a sell-off in the stock market, it's stocks that have like they're undervalued like this that I would start looking at. Let's look at some of the top holdings of the largest mutual fund in America. It's American Funds Growth Fund. And we see a lot of familiar faces in this. This is very similar to Fidelity Contra Fund. We have Meta, we have NVIDIA, Microsoft, Broadcom, Amazon, Netflix, Eli Lilly, Tesla, and Royal Caribbean. That is a new one. I never saw Royal Caribbean in anyone's top 10 in any mutual fund. So we might look at that next week. Not this week, though. What I'm Okay, here's a story that came out on Friday. American Express beats estimates. Um, okay, so basically, American Express they raised their guidance also, and sometimes it isn't if you beat estimates, it's what's your forecasts are going to be if the stock, that helps the stock go up and down. And we had Oracle, for instance, this quarter came out with earnings. They missed their earnings, but they gave rosy guidance and the stock went up. And this is very similar. They beat their earnings and they rose their full year guidance. So they're growing around 10%. I love companies that are permanent compounders that grow like 9 or 10% every year, forever. So um, they had earnings before they had projections of 8 to 10%, and now they have projections of 9 to 10%. And another thing I like about American Express, I'm pretty big on fintech. I own Visa and MasterCard and a lot of the banks. So I love the financial world because they're basically toll collectors. So if you buy something on their network, they're going to take a fraction of that, and that's how they make their money. So American Express makes most of their money through um, customers that are very wealthy. So that is one of the things that sets American Express apart from every other credit card, is most of their customers are pretty rich and they spend a lot too. So whenever people are talking right now about this credit crisis and people are maxing out their credit cards to pay for food, um, people, and if American Express sells off, that's a red flag because American Express, their customers they aren't borrowing money to buy food. They are buying luxury goods. So, American Express might not have the same credit issues as other credit card people. All right, let's look at the American Express's estimates. You can see that they're growing at like 15%. If you had to have 1% dividend, so it's like a 16% total return. So their PE ratio is 18. So that's 18 divided by 16 is 1.1. So they're about 10% overvalued according to my numbers. Um, we have a big, a concern this week of a credit crisis, some kind of crisis where companies are going bankrupt. We'll see. Jamie Dimon says if you see one cockroach, there are a lot more where that came from. So we'll see if that happens. If it does, we might have a correction of 5 or 10% in the stock market. Okay, let's look at some of the numbers for American Express. Their forward PE is 19, and their PEG ratio is 1.9 according to Yahoo Finance. Yahoo thinks they're 2 times overvalued. Their profit margin is 16. That's 13 is our minimum. Return on equity is 3 times what we're looking for. Um, total cash, they have basically 7 billion in debt, which is nothing for a big company. And they pay a 1% dividend. Okay, so it's a decent company. And they're going around 10% a year. And their chart is like a big, super good uptrend. And they're right in the middle of their channel and they're right in the middle of their stochastics. So they're neither overbought or oversold. They're just in the middle of nowhere right now. All right. Okay, so American Express CFRA said that they have a buy rating on it. And let's look at more detail what CFRA said. They reflect their positioning to weather economic pressures given high-end customers are less likely to default or cut spending. Growth drivers include acquiring 3M plus 3 million new cards quarterly and international expansion with a 50% card spend. Growth over 3 years from 6% market share in top markets. The premium card market benefits XP as the top 10% earners account for 50% of spending, 30% 3 decades ago. Okay, so they have they have ritzier customers. They have higher end customers that are likely to spend a lot more than the lower end consumers. Okay. And let's look at what CFRA said. They said they're overvalued by 14%. That is close to my estimate of 10% overvalued. So they've always sold for a premium also. So if there is a crisis where companies are going bankrupt and all the financials are going down, I would definitely look at this one. You can see in its earnings. mm, okay, with some inconsistent earnings times. Okay, this was COVID, so we can't say anything about that. But okay, it's kind of inconsistent earnings over time. Warren Buffett owns it. I mean, if Berkshire Hathaway has a huge position in this, it got to be something to look at, you know? All right, let's look at what Morningstar says. They said the fair value is 265 and it's 20% overvalued right now. Okay, that's close to what we had. So strong consumer spending drives double-digit revenue growth. So they agree that it's growing at double digits. We like companies growing at least 10% on a regular basis. So, um, all right, let's look at one more note here. This is S&P earnings growth, end of quarter estimate versus actual. So we had earnings that were expected to grow 8% this year. That's the gray amount. And the earnings end up to be much better. So that alone is a reason to be bullish in the market. You want to be invested in a market that's giving better earnings than expectations, because that's the formula for stocks going up is if the stocks beat estimates and increase their earnings, then the stock market goes up. Okay, so okay, that's all I had to say for today. I hope you really enjoyed that, and I'll see you next time.